There are always risks. Right now, if you asked us to say what the biggest risk is, it's probably not being long enough. It's being too risk averse. There are different regimes in the markets. In some regimes, the risk is upside risk. It's that you miss out by not being fully invested. And I think this is one of those regimes, right? I think this is a regime where you want to be taking incrementally more risk, not less risk. Everyone says, I'm bullish the market, but I remain cautious. Well, if that's the case, you're going to miss out. And maybe that's fine, especially if you have a long-term investment horizon. But if you have a more cyclical investment horizon, I think this is a time when you really want to be invested.
This podcast is sponsored by Cadiz Inc., NASDAQ ticker symbol CDZI. Cadiz is a water company that's shown great growth over the past 2 months. Cadiz has $5 billion in water assets and the largest water pipeline in the southwest. The Cadiz ranch holds twice the amount of water as Lake Mead. Led by CEO Susan Kennedy, the former chief of staff for Governor Arnold Schwarzenegger, Cadiz is eager to combat the water crisis in the southwest. Always do your own research before making any investment decisions. The information provided here is for informational purposes only and should not be considered financial advice.
Hi there and welcome to Stock Club, a podcast brought to you by MyWallSt. I'm Mike, and joining me in today's episode is Mike Singleton, the senior analyst and founder at the Macroeconomic research firm Invictus Research. As usual at Stock Club, we recorded this about 2 days before Biden withdrew from the election, so Mike's comments might be a small bit outdated, but considering Kamala Harris was VP for that tenure, they should hold just as much weight. This will make more sense to you when you listen to the episode, trust me. Before we get into the show, just a reminder for our loyal listeners, we have an exclusive offer with the code STOCKCLUB20. You can get 20% off across our entire product line here at MyWallSt. That means 20% off Invest or Invest Plus, where you receive our weekly Charging and Fearless newsletter, 10 starter foundation stocks, and our market beating stock of the month report. 20% off Horizon, our exclusive service where you can invest side by side with our chief investor Emmet Savage, or 20% off Nexus, our international service dedicated to uncovering hidden gems from around the world, which is currently outpacing the market and returning over 30% on average since its inception. So whatever you are in the market for, we've got you covered with the code STOCKCLUB20 at checkout. That is just for podcast listeners. Now let's dive into today's episode. Hello, and welcome to another episode of Stock Club. We have a very special guest on the show today, Mike Singleton, the senior analyst and founder of Invictus Research and a bit of a macroeconomics expert, especially when it comes to the US economy. He's on the show to give us just a bit of a lesson about what's happening in the US, all the kind of machinations and everything else. So Mike, very welcome to Stock Club. Thanks for coming on.
It's a pleasure to be here. Thank you for having me.
So before we get into the nitty gritty and I ask you, I'll put you on the grill for a bit. Can you just give us a bit of background about yourself and what you do at Invictus Research?
Sure thing. So I began my career at a long-only asset management company called Broad Run Investment Management. And the investment style at Broad Run was actually less macroeconomically oriented and more bottom-up. In other words, I spent most of my time analyzing individual companies, their competitive advantage, their growth runway, their management teams, and so on and so forth, doing bottom-up research. And it was a great experience. I really enjoyed my time there. However, after working there for a few years, something that I realized was the majority of the price action, even for an individual stock, was not driven by that company's fundamentals. The majority of the price action was really driven by macroeconomic sort of exogenous factors. And at the beginning of my career, that was a source of a lot of frustration, right? Because I would go into work every day, I'd check my brokerage account, stocks would be moving up and down, and I wouldn't know why. And, as an investor, you don't really have control over whether your stocks go up or down or when that happens. But it's good to know why things are happening if you can. And the fact that I didn't know what was going on was very aggravating. So eventually, I started to read more macroeconomic research, develop some mentors in that space, develop a feel for how growth and inflation and monetary policy influenced how individual securities trade. And I began to integrate that into my process as a stock picker, and it really improved my stock picking skills and my skills as an analyst. After a few more years at Broad Run, I decided to leave and start my own firm. That's how Invictus was conceived. And as it happened, I focused a lot more on macroeconomic and business cycle strategy at Invictus than individual company analysis. And I could go more into detail on that if you'd like, but maybe that's a good place to stop.
No, that's perfect. Yeah, and it gives us a good idea of the motivations behind Invictus and everything else, because especially if you're in a situation where you basically have to track short-term movements of stocks, you can do all your research and you find these great businesses, and you don't, like, we're looking at the chip stocks. We're recording this in the middle of July. We're looking at chip stocks tank today because of, a rumor of a decision Biden might make when it comes to American chip manufacturers selling to China. That has nothing to do with how a business like Nvidia or AMD is led or its ability to generate free cash flow. But the stock is down 7 or 8% because of that. And I guess that's kind of where you're getting at with the motivations behind it. But I was reading up on Invictus, and there's one really interesting point you made in one of your slide decks that I want you to expand on. And that's that investors in general are exposed to too much data, which stops us from being able to put it into context. I thought this was a really interesting point. So what do you think investors need to do to cut through the noise that you say is out there and parse out the important stuff for general investing, for what the average retail person would do?
So it's a great question, and there's obviously a lot of data out there. And on top of that, I think macroeconomic research or investing has a reputation for being esoteric or confusing, and perhaps it is. I think that the truth is, though, there are really only three macroeconomic variables that really matter when it comes to driving the price action of stocks or bonds or commodities or currencies or whatever. And that's real growth, inflation, and monetary policy. So if you get those three things directionally right, you're going to get a lot of other stuff right as well. Every other data point that we get at Invictus, whether it's consumer confidence or PPI inflation or whatever, any data point, the first thing that we ask is, how does this affect real growth? How does this affect inflation? How does this affect monetary policy? And if the answer is that it doesn't, for example, consumer confidence is a good example of that, doesn't really impact any of those three things, and it's just noise, right? Anytime we read a news story and we're like, does this news story matter or does it not matter? That's what we're asking. Does it affect real growth? Does it affect inflation? Or does it affect policy? So hopefully that's good news for your listeners, because that should help distill the signal from the noise when you're evaluating new data or when you're jumping from headline to headline. The way to contextualize all of these things is to ask, does it matter for growth, inflation, and monetary policy? That's the most important framework that I can offer. If you only take away one thing from this interview, hopefully it's that, right? If you get growth, inflation, and monetary policy right, you're going to get a lot of other things right as well. And if whatever you're looking at doesn't affect those three things, then it probably doesn't matter.
Perfect. So they're the big three written on the wall in Invictus.
Right. That's exactly right.
Okay, well, let's expand on that then. And for a beginner investor who's getting into the whole macro side of things and they want to understand more about the effect interest rates and inflation have on, well, we can say the economy, but we'll say in particular the stock market. Could you expand on that and maybe touch on the importance of the equity risk premium there as well when you do?
Sure. So we could think about it this way. There are two fundamental drivers of stock returns. You could say the price of the stock index is equal to the expectations about future earnings times some multiple, right? Some valuation multiple that the market is applying to those earnings. So if we break things down that way, it gets us back to that original framework, right? You could break down earnings into the real growth element, and you could break it into the inflation element, right? But inflation plus real growth will get you nominal earnings growth. And then monetary policy affects the multiple that's applied to those earnings, although it only explains about half of the multiple. The residual is equity risk premium, right? So, this is just sort of a stock specific way of saying what really matters is nominal earnings growth driven by real growth and inflation, and then the interest rate, which is kind of set by the Fed, and the equity risk premium. Now, equity risk premium is not as actionable over the short term. In other words, if we were looking at equity risk premium today and returns over the next 3 months, 6 months, 1 year, 2 years, 3 years, 5 years, it doesn't matter, right? So equity risk premium is not a tradable insight over the short term or even over the intermediate term. If you're looking at the equity risk premium, and we do a lot of valuation work, the only context in which it really matters at all is over the very long term. So equity risk premium matters if you're looking at 10-year forward returns, right? That's when the correlation is closest. And that does matter for some investors, right? When you're maybe talking to pension funds who have a very long-term investment outlook, or when you're talking to maybe you're a financial advisor advising someone who's 30 years old and has a 30-year investment horizon until they retire, then you might look at equity risk premium. But for anyone who has a shorter term time horizon, and candidly, that's most investors, equity risk premium isn't quite as important, which is why we're not saying it's as important as growth, inflation, or monetary policy. It technically is a driver. It's just generally not as actionable.
Okay. And I'm kind of speaking on behalf of our listenership, but at MyWallSt, we've always employed a long-term investing strategy because we know it works in terms of we invest in stocks, we find good businesses. We don't have to worry about short-term trends and fads, because if you do hold for that time period, then it kind of irons out a lot of kinks. If you hold quality for the long term, it usually works. Now, finding quality is the tough bit of that equation. But if you're in the macroeconomic side of things, you are automatically forced to think more short term. That's the only way you operate is in the short term, because it's almost trying to predict 6 months, 12 months, 2 years, 5 years out and find the best source for your cash. Is that a fair way to say it?
Right. So I think that macroeconomic investing, you generally have a long-term view, but most of your ideas, at least our ideas at Invictus as business cycle analysts, are sort of predicated on the waves of the business cycle, right? Growth is accelerating, growth is contracting, inflation is accelerating, inflation is contracting. And those oscillations in the business cycle are typically 6 to 18 months in duration. So that tends to be our investment horizon. Now, that said, there are a million ways to make $1 million. And what you just said is true, right? If you're picking the best companies and holding them for the long term, that's a very good investment strategy. And having a long-term investment horizon is a tremendous asset if you actually have a long-term investment horizon.
And that's true. It could be a luxury for a lot of people that can't afford it.
Right. That's absolutely true. And the only risk or caveat maybe I would mention is that it's important as an investor to be honest with yourself about what your investment horizon really is. And for a lot of investors, maybe some of their capital is very long-term, say a retirement account. But if you have a shorter term pool of capital, maybe like just a brokerage account for fun or something that maybe you're going to draw on if you buy a car or a house or something, you should just be honest about, whether that is actually long-term capital. Because if it's not, you have liquidity risk. You have the risk that the market goes down and then you need to buy a car, and all of a sudden you're taking out a $30,000 withdrawal in an account that's drawn down 15% or 20%. And, that's not a super positive outcome. So, if you can have a long-term investment horizon, it's a great asset, but you want to be sort of honest with yourself about whether you can actually do it. I know a lot of people that have thought they could and couldn't, and that's a bummer.
Yeah, and it's very true as well. You're talking about being honest with yourself when it comes to your when it comes to your timeline, but also being honest with yourself when it comes to risk appetite is a really common pitfall a lot of investors find themselves in, where, oh, I'm okay with high risk when it goes up, I'm not too okay with high risk when it goes down, So, and they all mesh together, because that is a lot of the factors of why someone can't hold for the long term, is because they can't handle the volatility on the downside. So you talked about the business cycles there. I'd love for you to expand on that and maybe touch on strategies that suit each part. So we have like high GDP growth, high inflation, high GDP growth, low inflation, and go through kind of where you would allocate assets depending on the cycle.
Sure. So like we said a second ago, the primary drivers of the business cycle are real growth, inflation, and monetary policy. For the purposes of keeping things simple, maybe we'll focus on real growth and inflation for just a second. If those are the two most important things, monetary policy aside, then that implies there's 4 distinct economic regimes that you might invest through. You can invest when, economic growth is accelerating and inflation is declining. You can invest when they're both accelerating together. You can invest when growth is declining but inflation is accelerating, or you can invest when they're both declining together. So what's going on right now? Well, or what kind of market regime are we in, I guess? At Invictus, we believe that we're in a reflationary market regime. So that means faster economic growth and faster inflation at the same time. And so what we do is we run a bunch of back tests to determine what are the equity sectors and style factors that tend to perform best when growth and inflation are going up at the same time. And the answer to that is, well, one, how do stock market indexes tend to perform broadly? The answer is very good, right? So the S&P 500 tends to perform very well. The Russell 2000 tends to perform very well. The NASDAQ, the Dow, the indexes broadly do well. If we look into sectors and style risks, what tends to perform well? Well, first, cyclicals, right? So technology stocks, consumer discretionary stocks, industrial stocks, financial stocks, et cetera. What tends to not perform as well? Defensive. So think healthcare, staples, utilities, real estate. So you want to be overweight cyclicals and underweight defensives. Generally speaking, you also want to own higher beta stocks. You want to own small cap stocks. Now, these aren't rules necessarily in the sense that small cap stocks don't always outperform through reflations, but historically, the odds are better than average that small cap stocks will outperform. We haven't really seen that this cycle.
No, it's just
except
been
in the last.
Just been the Magnificent Seven,
right.
basically.
Right, and large cap tech stocks do perform well through reflation, so we shouldn't be surprised at that. The extent to which small caps have lagged is really the more surprising feature. Of course, in the last week or so, we have seen some evidence that that's reversing. Our suspicion is that will persist, that small caps will probably outperform large caps through year end. We'll see. It's kind of a logical place to see sector or factor rotation into something besides large cap tech. We have a few back tests that suggest perhaps that's probable at this point. But in general, you want to be risk on, right? So you want to own stocks. You want to own stocks that are more cyclical. You want to own stocks that have more leverage, generally speaking. And you could extend that logic into the other asset classes. So when you're looking at bonds, you want to take credit risk. You want to own high yield bonds rather than investment grade bonds or treasury bonds. You want to own leveraged loans. You want to own business development companies, for example, as a source of yield, mortgage REITs, and so on and so forth. Within commodities, you'd rather own base metals than precious metals, so things like copper or tin or steel or aluminum, as opposed to silver or platinum or palladium. And even within the currency markets, you could apply the same logic. You want to be moving toward more cyclical countries and currencies, so maybe things like the Aussie dollar or the Canadian dollar, and away from safe haven currencies like, say, the Swiss franc or the Japanese yen. And so anyway, long story short, through reflations, through the regime that we believe that we're in now, you generally want to be positioned risk on across asset classes.
Okay. And when you mentioned that we're in a period of high growth and GDP growth and in growing inflation as well, how are you positioning that business in the sense that inflation has kind of been on a downward trend since last year? Is it that we're still overall growing inflation, or how are you explaining that?
So it's a good question, and it depends on which way you cut the data. So the way that most bottom-up fundamental analysts tend to look at data in general is year over year. And that's very logical, because when you're looking at a 10K, this is how business owners think about their business. When you ask them, hey, how'd you perform in Q1? They're comping this Q1 against the last quarter's Q1, because most businesses are somewhat seasonal. For example, it doesn't make sense for a retailer to compare January to December, because December is Christmas, right? And so January will always look bad relative to December because of that inherent seasonality. What economists tend to do is they seasonally adjust the numbers so that you can do an apples to apples comparison between January and December. And the reason I'm saying this is because you'll hear economists throw out phrases like the 3-month annualized rate of change or the 6-month annualized rate of change instead of the year over year numbers. And the reason that they do that is just to get a higher frequency look at momentum in some time series than a bottom-up investor will typically get, because they're getting quarterly data rather than high-frequency data, and they're never annualizing the data because it doesn't make sense to do that for a business most of the time. Okay, so when we looked at the inflation data, we were disinflationists from June of 2022 until the end of 2023, and that was the right call, right? We saw inflation decline from 9% year over year to 3% or something like that. And then into 2024, we said we thought we were going to get a reflationary impulse as a consequence of base effects, but also a really strong labor market, wage growth that was continuing to comp in the 4.5%, 5% range, driven by very low unemployment and high fiscal deficits. And then we also thought that durable goods were going to rebound. as a result of the decline in interest rates that we saw between October and December. And that played out, right? If you looked at the January, the February, and the March inflation prints, they were all in the 0.3 to 0.4% range. So they were consistent with annual inflation of 3.5 to 4%. Hot, right? That was hotter than the prior 6 months. That was hotter than the Fed's target, which is 2%, obviously. And then in May and June, we've seen the month-over-month prints in the range of basically flat, right? And if you looked at core inflation, it maybe 10 basis points or something like that. So consistent with sub 1% inflation. So we've seen very, very soft inflation in May and in June. But prior to that, it was reaccelerating. The question is, what's more indicative of future inflation, the last couple of months or the 3 months prior to that? Were the inflation readings that we saw in May and June outliers, or is this indicative of a new trend of disinflation? At Invictus, we're open-minded, but we would suggest that the May and June data, the really, really soft inflation that we saw in May and June, they're probably outliers. And the reason that we say that is, well, you have to think about what ultimately drives inflation. It's supply and demand for goods and services in the economy. The price of anything, stocks, bonds, commodities, or goods and services, is always set by supply and demand. And demand for goods and services is just growing too fast to be consistent with 2% inflation, right? Consumption growth and income growth are both growing at, call it 5.5%. The US economy cannot produce goods and services at a rate of 5.5%, right? The economy can grow at roughly probably 1.5 to 3% over the long term. And that delta between 5.5% and 1.5 to 3%, or whatever I just said, that's equal to inflation, which means that the US economy will probably see inflation stabilize between 3 and 4%. That's not the Fed's target. That's still above trend. That implies that the year-over-year data should really not go really far below 3%. And when you're looking at most of the data, it's going to look like it's inflecting higher in rate of change terms. And that's why we are reflationists. Now, we could be wrong. We could provide caveats to that thesis and certain indicators to look at in case that we are wrong. But right now, that's our base case.
Okay, that's really interesting. And you've touched on the Fed a lot within that. I'm curious how that matches up. I think I saw something recently where traders are basically pricing in with the 100% certainty that the Fed is going to cut rates in September. Does that match with your prediction that we're going to see consistent 3 to 4% inflation over the next year, 2 years?
So not really. I mean, it doesn't make sense. It doesn't make sense to cut rates if you think inflation is going to rebound. So our views on inflation differ from the Federal Reserve. That said, the Fed doesn't necessarily look at the same data that we do or interpret it the same way. And if you listen to what Chair Powell has said in the last couple of weeks worth of public appearances that he's made, in my view, there's clearly been a shift in terms of his rhetoric away from inflation risk and toward risk in the labor market. And the big red herring in the labor market right now is the unemployment rate. We've seen the unemployment rate go from 3.4% in the beginning of 2023 to 4.1% right now.
So
that means it's increased
somewhat by design.
Right. It was by design because they thought that creating slack in the labor market would cool wage growth, which would cool services inflation, and therefore, the broad headline inflation in core as well. So right, it was by design, but it's getting to a point where Fed officials are starting to worry about it. And I'll give you a couple of figures for why that is. The first is, if we look at recessions going back to the 1940s, the average increase in the unemployment rate from the cycle trough to the first month of the recession is 62 basis points. So 0.62%. So the fact that we've seen a 70 basis point increase in the unemployment rate, that's consistent historically with recessions if we're just looking at one indicator, right? And so that's going to alarm the Fed, and it's going to create sort of a red light in terms of assessing the balance of risks. They're going to start to be concerned about the labor market. Additionally, there's kind of a famous rule called the Somme recession rule. I don't know if you've heard of it or not, but essentially it states that when the 3-month moving average of the unemployment rate increases above the 12-month cycle low of that 3-month moving average, it means that there's a recession. Your listeners can maybe pause and rewind that definition if they want, or look at it on Google. But basically, if the unemployment rate goes up a certain amount, and you look at the moving averages, it means that there's a recession. The SOM rule will be triggered if the unemployment rate goes up another 10 basis points from here. So if we see the unemployment rate go from 4.1% in June to 4.2% in July or in August, that will trigger the SOM recession rule, which is a rule that, for whatever reason, the Fed takes pretty seriously. I mean, the reason they take it seriously is because historically it's been a good recession indicator.
But
In my
aren't
view,
we in the longest time period ever of an inverted yield curve right now, which is what the number one recession indicator? So there's
right. Historically, that's been a good recession indicator as well. Although the Fed tends to focus more on hard economic data than financial market indicators. So you won't hear the Fed talk as much about yield curve inversions as they do about like the unemployment rate or payrolls growth or something like that. But this is just to say, if the SOM recession rule triggers, and it looks like it probably will, it's hard to imagine, given the Fed's historical rhetoric, that they're not going to cut interest rates at least once, even if we're right and inflation remains in the range of 3 to 4%. So I guess I'll pause there because there's more to go into if you'd like. For example, why do we think inflation is going to reaccelerate if the unemployment rate is going up to 4.2%? But I'll stop there and let you take it where you want.
For sure. And like we could be here all week and I'd be trying to catch up with you, trying to figure out fully what you're saying. But there is one story that is going to absolutely, unfortunately, dominate all of our timelines from now until November, and that's the election. So I'm very curious to hear what you feel. I'm going to ask you two questions, which I know is a bad interview tactic, but the first question is, in general, how do you feel about elections when it comes to the stock market and the US economy in general?
So it's funny you ask that. I think most of the rhetoric around elections is around risk, right? Uncertainty. Markets dislike uncertainty. So it feels very intuitive that stocks should not perform very well ahead of the election. Historically, that's not really the case when you look at historical seasonality. Election years tend to be good years for stocks. And I'll give you one statistic just because it's on the top of my head. In years where the S&P 500 is up 10% or more through June, in other words, stocks have had a good year in the first half, and it's an election year, stocks tend to go up another 6% in the last 6 months of the year. That's the S&P 500, which is above average. Again, just more evidence that in election years, stocks tend to perform pretty well. I'll also say that, in a sense, this election should be less uncertain than historical elections in the U.S. Why do I say that? Because President Trump has been president.
Already, yeah.
That's exactly right. So you know what to expect. And the good news is stocks have done pretty darn well under both presidencies. So I think if your fear is that there's going to be some sort of aggressively anti-business policies that affect the stock market, it's probably unlikely because we haven't seen anything like that in the last 8 years. Both presidents are big spenders. President Biden has run a deficit that is very, very large relative to U.S. history without a recession, without a war. President Trump also ran relatively large deficits. I don't know that there's a future in which deficit spending in the U.S. goes down significantly. And while that sounds bearish, it's actually bullish. And there are a number of accounting identities you can use to prove this out. Government spending, all else equal, increases corporate profits. If you want to look up the sectoral balances equation, it's an accounting identity that bears that out. The Kalecki levy profit equation. It doesn't necessarily mean better economic conditions because it can be inflationary, but it usually means better corporate profit growth, which in turn means higher stock prices, all else equal. So given that we have two presidents that are relatively business friendly and both are fully planning on running very high deficits, which will very likely goose corporate profits, it's hard to get really bearish on the premise that either of these two candidates are going to somehow sink the stock market.
Yeah, and you've basically answered my second question, where when it comes to specifics, I thought it's very interesting how we have 4 years of data for each president. It's both quite positive for the stock market. But in general, is there a skew towards a certain makeup of the political, so like the executive, the House and the Senate, in terms of one that suits stock markets? Because we've been through this before, and I feel like the data is almost not obviously anecdotal, but it's so conditional, like as in we found a sweet spot was with a Democratic president and I think a Republican controlled House and Senate. But that data was so skewed because Barack Obama came in at like the absolute nadir of the great financial crisis and saw 8 years of pure bull market, which was, and for most of that time was, I think, his makeup in terms of a Republican House and Senate. So is there much use in like saying, oh, Republican candidate is usually more beneficial to the stock market, or is it a different circumstance now?
I've never run a back test or seen any data suggesting that. I could give you sort of high level principles, like long term principles about how the composition of the deficit would matter in terms of long term growth. But if you're just looking historically at Republican presidents versus Democrat presidents versus, the amount of control one party has in Congress or the other, I have never seen a meaningful difference in how the stock market performs. But maybe I just haven't cut the data enough ways.
Okay. Okay, I'm going to change tack now. And all right, bear with me. So I'm going to throw a few stats at you here. And there'll be a question coming in the end. So 29% of the S&P is made up of 6 technology companies: Apple, Microsoft, Nvidia, Amazon, Google, and Facebook. The top 25 stocks account for 48% of the about 50 trillion market cap of the index. While this is true, estimates have tech's total contribution to GDP at about 10%. So there's a big gap there in terms of its effect. And on top of that, about 40% of revenue from S&P companies comes from outside of the US. Only 18% of employment comes from the S&P 500, and 87% of firms with revenue over $100 million are private companies. So based on all this, do you think people are too ready to lump the stock market and the economy in together, as they're obviously not one thing, but it's just that ipso facto, if the stock market's doing well, the economy's doing well? Is it not? They should be further separate entities based on a lot of the statistics I brought there.
So I would suggest that the opposite is a more typical problem when I speak with investors, right? Or read the press, right? Read the financial media. It feels to me like everyone is very quick to say the stock market and the economy are different. They're disconnected. They have nothing to do with each other. One goes up, the other goes down. What's going on? And what I would suggest is that the stock market and the economy are actually much more closely linked than most folks appreciate. And it would be easier if I had some charts to show you. But if you look at the correlation between any measure of the macro growth cycle data, whether that's GDP growth, the manufacturing PMI data, the weekly economic index, personal consumption expenditures, whatever, and you look at the correlation between those variables and S&P 500 earnings or the performance of the S&P 500 itself, there's a very close correlation, right? They trade right on top of each other, which should be pretty logical, right? When economic activity broadly is accelerating, you would expect to see corporate earnings growth accelerate at the same time, right? Because the goods and services that people are spending money on are, frequently publicly traded companies. And you see stocks follow their earnings or really discount their earnings in advance. But the principle holds steady, right? Stocks ultimately trade on their fundamentals. There are periods of time where it seems like they're not, especially periods of time where the Fed is very, very active in financial markets. But those tend to be the minority of cases, and they tend to be relatively short in the scheme of the full business cycle, right? So I'd say in principle, it's better to believe, it's better to understand that most of the time, the economic fundamentals and financial markets track each other reasonably closely. Although financial markets are discounting mechanisms, right? So they generally trade ahead of the fundamentals by about 3 months.
Okay, that's good. I like that. I am very...
And a lot of times that can be very confusing during those 3 months, right? Especially when you're seeing major trend changes. And I think that's when people tend to really say, oh, the stock market's broken. But really, their expectations are just not, the stock market is just smarter than they are.
Yeah.
And they need to adjust their expectations. How many people said the stock market was broken in March of 2020 because, or I'd say April of 2020 because stocks were ripping?
I was just going to say, right? I remember this. We were watching basically the world burn outside our windows. We couldn't leave the house. And the S&P had the 50 the best 50-day stretch of its history was from something like the nadir of the COVID crash. The 50 days from there was the best ever, and people
Right.
couldn't
And
compute that, how the stock market was so away from the economy, I guess.
right, because you were sitting in your house, you were locked up, you were seeing COVID case counts, within spitting distance of new highs. You were seeing cities getting burnt down, and you're thinking, my God, this could be the end of the world. Why are stocks, pushing multi-month highs? And the reason is because the stock market wasn't looking at what you were looking at. It was looking 3 months ahead or 4 months ahead. It was looking at cities reopening. It was looking at vaccines coming out. It was looking at accelerating economic growth and the different the leading indicators for that. And it's just really, really hard for investors to look at the way things are likely to be instead of what's happening now or what's happening in the past, and they can be very different. And that was admittedly, that was a challenging time to invest, but it was a very rewarding time to invest if you got on the right side of the business cycle.
Big time. And what you talk about in terms of the big three, the zero interest rate policy was a huge factor in that as well. And it took a lot of people a lot longer to realize. And it becomes very obvious in retrospect. And we have a lot of the memes now of this is what happens in a ZERP policy or whatever else. But it goes to show what you're talking about. There's real meat to this. And that's what drives so much of the short-term movement in the stocks. And then they can move well away from their fundamentals over that time period as well. Okay, I'm so curious now, and obviously you don't have to give us a list of your holdings or anything, but just how you invest personally based on how you work and the research and advice you give out to your clients. How does that affect your personal portfolio? Are you kind of just index and forget about it, or do you like to make moves and bets and all the rest?
So I would say it starts very top down. What's the economic regime that we're in? Like I said earlier, the house view at Invictus right now is that the global economy and the US economy are reflating, right? Faster growth and faster inflation. Okay, so that's our expectation. The next question is, what types of assets broadly tend to outperform in regimes like that? And like I said a few minutes ago, it tends to be risk on assets. So stock, credit, crypto, stuff like that. So from there, we continue to run back tests within the stock market. We're asking questions like, what are the style factors in sectors that tend to outperform? And that's where we look for new ideas. So right now, where are we looking for new ideas? We're looking for, generally we're looking for cyclical, exposures. So technology, consumer discretionary, industrials, financials. Probably we have a slight bias towards small caps, although we certainly like large caps as well. We like both value and growth, and we're generally positioned risk on. On top of that, I would say that at Invictus we tend to be trend followers as well. So we're this is probably less what your audience is interested in, but we're looking for ideas that backtest well in a given economic regime, and then we like to see stocks breaking out of bases on high volumes, exhibiting relative strength relative to the broader market. And if any of your followers have read How to Make Money in Stocks by William O'Neill, it's very consistent with the William O'Neill style of investing. That's a book I recommend in case anyone is interested.
Oh, perfect. Yeah. All right, that's great. I'll check it out. Okay, I am going to finish up now in a bit, but I have one question I think I'd love to hear your opinion on, because I think it could be very impactful going forward, especially as stock investors. And it's around valuations. So the S&P is currently sitting, it's near as expensive as it's ever been. It's 20 something times earnings. And a writer I love, Ben Carson from About the Common Sense, he believes that this is going to be a new norm of sorts in terms of the valuation landscape. So it's based on stock market participation is at all-time highs, and there's so few barriers now to the stock market. We have commission-free trading, auto-inclusion retirement accounts, tax-efficient accounts, different ways like auto-investing, just set and forget ETFs, whatever way you want to invest, you can get your money into the stock market very easily. And we've also been basically a bull market since 2009, minus a few blips. Do you subscribe to this notion that we could just be in a different valuation landscape from now on? Or do you think we'll revert to the mean and that the kind of historical averages will play out as they always do?
So if you look at it's a good question. I mean, if you look at the valuation data over the last 150 years, Robert Shiller has all this data available on his website going back to 1871. It is cyclical. US valuations have trended higher since 1871, right? If you draw a line of best fit or like a trend line, it goes up and to the right. Doesn't mean it always has to be that way. But that's been the trend for 150 years. My suspicion is it'll probably be the trend for a little bit longer. So I think that's supporting evidence for what you're saying. I would also just reiterate what I said, a few minutes ago. Valuation is really a long-term consideration. It's really only relevant if you have a hold period. The correlation starts to matter once you look 5 years out, and it's closest when you look 10 years out. So it becomes a very important consideration if you're looking 10 years out. It can account for up to 40% of the return when you look 10 years out, which is a lot, right? Only 60% has to do with the company's fundamental performance. 40% is due to just the price that you bought it at. That's remarkable. So, I'm not particularly worried about valuations being high because it sort of extends beyond my time horizon. But I think it is something to consider if you're a longer term investor. And I will caveat it by saying, like, look, U.S. valuations have been high for a very long time, and they've continued to get higher for the last 150 years. It doesn't mean they can't go down. It's just the longer term trend has been up for a very long time. So I'm sorry if I kind of danced around your question a little bit, but that's it. That's all I've got for you.
No, it's good. It's good. I like it. Higher for longer is what you're saying.
It's a type of higher for longer, exactly.
Okay. Just a few more and then we'll finish up. So one question I wanted to ask is just around certain risks to the stock market. So my mind obviously goes to, we've been through the concentration at the top of the stock market. Would you see that as a long-term risk factor, or do you think those businesses are there because they're the highest quality businesses and their earnings and their revenue deserve to be at the level at which they are?
I mean, from a bottom up perspective, the companies that you named earlier, Microsoft, Apple, Facebook, Google, they're extraordinary companies, right? Relatively low investment needs, very, very, very high returns on capital, extremely wide competitive moats, some of the best management teams in the history of American capitalism. It's hard to argue that they don't deserve to be there. That said, capitalism is a brutal system, right? And over time, competitive moats tend to get worn down, and competitors tend to, bankrupt incumbents. But it takes a very long time, right? And sometimes it takes the government. And I'm not saying I'm a proponent of breaking up the big tech companies. I don't even really know how it would be done, but it's certainly possible. It's certainly, a risk. I don't know if it's an investable risk right now or an imminent risk. If you said, hey, you need to go buy FANG or short FANG, I would buy it in a heartbeat before I would sell it short right now. But that's probably the best thing that I can say is I don't think that's an investable risk right now. It is a risk, but I would never put money on the line on that premise. I shouldn't say never. I wouldn't do it right now.
Yeah, yeah. And then in terms of other risks, do you see any major concerns at Invictus around the stock market over the next 12 months, we'll say? What would be the biggest kind of red flag?
So, I mean, there's two reasons that the stock market can decline fundamentally. One is earnings go down, and two is that the Fed does some sort of policy shock, right? Raises interest rates really fast. In my mind, those are the risks of 2022, right? We saw earnings growth decline very quickly, and we saw the Fed raising rates at the same time. That's why we saw the S&P 500 decline 25%, the NASDAQ decline 35%, the Russell decline 30%, right? Those are yesterday's risks, and investors always have the temptation to fight yesterday's war instead of looking forward. And that's not to say that we couldn't see an earnings shock or that the Fed couldn't hike rates to 10%. We just think that's very unlikely. Right now, we think the odds of a hike are basically zero, and the odds of a cut, at least one, are reasonably high, call it 75%. And on top of that, we think that earnings growth is going to be in the range of 12 to 13% this year for the S&P 500. it's hard to imagine stocks not going up against that backdrop. Now, we could be wrong. Maybe the S&P 500 only grows earnings at 10% or 11%, but that's still 10 or 11% earnings growth, right? That means that all else equal, the S&P 500 is 10 or 11% more valuable. It's 10 or 11% more earnings that these companies can potentially distribute to shareholders. So, there are always risks. Right now, if you asked us to say what the biggest risk is, it's probably not being long enough. It's being too risk averse. There are different regimes in the markets. In some regimes, the risk is upside risk. It's that you miss out by not being fully invested. And I think this is one of those regimes, right? I think this is a regime where you want to be taking incrementally more risk, not less risk. Everyone says, I'm bullish the market, but I remain cautious. Well, if that's the case, you're going to miss out. And maybe that's fine, especially if you have a long-term investment horizon. But if you have a more cyclical investment horizon, I think this is a time when you really want to be invested.
Yeah, big time. The risk of doing nothing is very much under indexed by a lot of investors, I think. Okay, so final question here, and it's more so advice than a question. I just want you to give definitely me, but our listeners as well, just some recommendations for someone who wants to get into the macro side of things, spot trends, see the importance of the kind of research you're doing. What would be the best advice to get started, or where would you send someone?
So I think that Invictus, my company, obviously provides some good resources on this. I think that the Daily Edge is probably one of the best places to start, whether you're a beginner or you're an experienced market professional. It's a 5 to 10 minute video that covers the economic data from the day prior, puts it in the context of the business cycle, sort of helps you understand what the implications will be for the different asset classes with a focus on stocks. We also have some courses that we offer that sort of condense the knowledge, hopefully the learning experience, into a few hours rather than a few months or years. I like the John Murphy technical analysis books, especially the books on intermarket analysis. And I know that's going to sound like sort of blasphemous to a lot of bottom-up investors, like technical analysis. That's like witchcraft or something. But the truth is,
horoscopes for finance bros is the going rate.
Exactly. But in my mind, the way that I think about technical analysis is not like, marching soldiers pattern or head and shoulders or, a triangle pattern. It's more about understanding how markets price in fundamental developments, because that's really important, even for fundamental analysts, right? When growth is going to reaccelerate, what are the market signals that you're looking at? Because as good as you might be at forecasting earnings, you might still be wrong. And if understanding how to read the market tea leaves can help you get a call right, even if your models are a little off, that's super valuable, right? So learning how to use technical analysis, I would say, is very valuable, even if you're a fundamental investor, even if you don't invest just on the basis of the technicals. It can sharpen your analytical, market cycle skills quite a bit. Intermarket Analysis by John Murphy is a very good book to that effect. I wish I could give a better recommendation on, a book recommendation for business cycles, so to speak. In my experience, there are not a ton of really good ones. The Ray Dalio books are, what most people would recommend. In my mind, that's a lot of marketing for Bridgewater.
Yeah,
if you have the tolerance,
I just finished listening to The Fund, so I'm kind of staying away from Ray Dalio for a while. It was very damning.
Yeah, you have to have a high tolerance for sort of like marketing collateral,
Yes,
right? Because I think that was ultimately the point of those books. But there's some good information sort of hidden away in there. So, if you're really into learning about the business cycle, Ray Dalio is sort of the OG. But he just, he talks a lot without saying a lot sometimes. So you have to be willing to accept that.
Yeah. Yeah. Okay, Mike, it's been a pleasure having you on. I've never felt less smart interviewing a guest than I have trying to keep up with you. But it's great. Where can our listeners find you if they want to hear more?
So our website is invictus-research.com. My Twitter account is @InvictusMacro. I'll also say we're launching an AI enhanced mobile app that will be trained on all of our research. So if something that I say, I really try and make sure everything I say makes sense and is accessible and is not really confusing because I think that's terrible. Anyway, the mobile app will be trained on all of our research. You can chat with it. You can ask it questions. If something I say doesn't make sense or I use a word that doesn't make sense, the AI chat will help you work through that. And so that'll be launched in the next month or so. But I wanted to bring that up because I know, like what you just said, a lot of people feel that way about macroeconomics and business cycle analysis. And I think this will be a really good tool for helping with that.
Brilliant. Okay, well, I'm looking forward to seeing all of it, and I'm going to take your recommendations to heart for sure. Mike, thank you very much for joining us, and everyone else, thank you very much for listening in. If you are listening to this on Spotify, on Apple Podcasts, wherever you get your podcast, please make sure to give us a 5-star review. It does help us. All right, that's it. We'll talk to you next week.